Palomar Holdings is a small cap with just $3 billion in market cap. Its revenue is $682 million. Forward P is 14.6, and analysts do think it's discounted by 29%. Over the 5 year, this stock hasn't kept up with the other insurance companies that have gone up in appreciation more than 100%. But over the 1 year, it is getting the job done with 16.86% rate of return. So overall, this is an interesting stock that it's had more volatility and not a consistent upward trend. This is a smaller business, really growing fast, 53% growth. That looks really good. Looking at their statistics, their price to book is 3.6. These smaller businesses are going to have trouble with the price to book. And this one is a high price to book, meaning you're paying more for the business. It's more expensive. You want this to be as low as possible. If it's below 1, that means the book value is actually more value than the actual stock price. In this case here, we're at 3.6. So that's very high, showing that it is very expensive. Return on equity of 22.4 is fairly decent. When we look at the forecast of this business, we've got 7 analysts covering them, saying this is really discounted. They expect that the business is going to continue to grow in 2026 by 18%, which would be impressive. And overall, their earnings per share will expand, bringing down their PE ratio. So the growth does look really interesting for this small cap. The combined ratio for Palomar is really impressive, 78.8%. That's the lowest that I've seen so far, showing that this particular insurance company is making money. That means that their expenses are roughly 78.8% of what they're bringing in the form of revenue. When I value Palomar's stock, I get a 50% discount. I believe each share is worth $230 when I weigh the value of their cash flows as well as the value of their earnings per share. But the stock is trading at 114. So this has very good upside. It's riskier, but it has very good upside.